Hello,
Hello.
everybody. Happy New Year.
Yes.
Welcome to the new platform here. Just quickly before we get started, it should be pretty intuitive. We got the chat, which most of you are figuring out on the right-hand side. We're not going to have any polls today, but in the future, you can see that right next to it. And then we're going to have a handout, which you can download at the end of the slide deck. And we're going to be sharing a few links throughout as well. So I guess we'll get going then today. So let me just introduce ourselves as a team, because I noticed that there's quite a few guests today on the webinar. My name is Lorenzo Pederzani. I'm one of the portfolio managers at the Westmount Wealth Group. With me is Joe Basque, who is one of our financial planners, and Mehul Gandhi, who's another one of our financial planners in our sister company, Westmount Wealth Planning. And Matt is going to be jumping on here in a moment, and he is the other the other portfolio manager, I should say, as part of the team. Today we have a pretty full webinar. We generally like to keep these to 30 minutes in length. Today we might go a little bit over just because we have so much to cover. So let's get right into it. Matt, is there anything else I missed at the intro here?
No, that's everything.
Nope. All right, let's do it. As always, our typical disclaimer, anything you hear today is Matt or my opinions. It do not represent the opinions of the firm, Hollis Wealth, or Industrial Alliance Securities. One little piece of housekeeping that we will get out of the way. A number of you, well, all of you will have, who are clients will have received letters last week in the mail. Many of you received quite a stack of letters indicating that Hollis Wealth went through a name change. So those of you who've been with us since 2017 will remember that previously Hollis Wealth was owned by the Bank of Nova Scotia. It was sold to Industrial Alliance Securities in 2017, and they had the right to keep the name Hollis Wealth for a period of time, and they have chosen to rebrand to IA Private Wealth. So it is simply a name change. You know, as your advisory team, Westmount Wealth Group, we are still the same team. The back end where your money is held, the custodian, which is National Bank, is still the same. Quite simply, Hollis Wealth Industrial Alliance Securities has become IA Private Wealth Industrial Alliance Securities. So please use our Westmount emails going forward. They will be redirecting the Hollis Wealth email addresses for another year, but the Westmount email addresses will, keep into perpetuity. And any of you who are missing direct contact phone numbers, we've listed that in there as well. Again, this presentation will be available for download at the end of the presentation today, so feel free to download it for all that information. So let's get right into it here and talk about what happened last year. Certainly nobody on January 1st, 2020 was expecting the new reality that we have all experienced this year. The year started off pretty good in the stock markets, with markets being driven by kind of tech and glamour stocks. As word of the pandemic started to spread, of it, reaching outside of China, particularly the crisis in northern Italy that developed, we saw global stock markets react very dramatically with 30-40% drops in the span of a month. Federal reserves and central banks acted rather dramatically to inject liquidity into the system in the same way that they did in 2008, and that really helped calm the markets and prop up the recovery. Interesting things to note that happened last year. For a while, Shopify overtook RBC as the most valuable company in Canada, as the e-commerce, the power of e-commerce started to really show itself in a pandemic, environment. Gold also had, after languishing for about 9 years, a very strong recovery, hitting all-time highs. Gold is now past $2,000 an ounce. Obviously we witnessed, a lot of uncertainty around the U.S. election, which hopefully will be coming to its conclusion in the next week with, Biden being elected. And then really the big story at the end of the year was, as the vaccine rollout started to happen, stock markets really priced that news in. So oddly enough, even though we had a very dramatic February and March in the stock markets, we ended up the year in positive territory for 2020. One thing to note, though, is that, when things got bad, they were pretty bad. It's easy for us to look back now 10 months and forget just how dramatic the downturn was. If we take a look in the US, for example, at the 25 worst single-day drops in the US stock market history, we saw 3 of them last year, and all of them actually happened within a 7 trading day range. So a very dramatic series of losses. One of the fastest, I believe it might have been the fastest, depending on how you cut the data, drop ever in the markets, but kind of coupled by one of the fastest recoveries. So certainly a bit of an unusual situation. If you want to kind of compare this, situation to other times in history, the most severe market depression we've ever seen, obviously, was the Great Depression, where we saw, from its peak in 1929 to, the bottom almost 3 years later, an 86% drop in the stock market in the US. And that took a staggering 25 years for the markets to recover. Essentially that great crisis started a whole new wave of macroeconomic thinking led by people like John Maynard Keynes that came up with the idea that, when markets, drop, it is important for federal governments to react and to add stimulus, which they hadn't done back in the Great Depression days. And since then, we've seen, governments take on a very moderating influence to market downturns. The financial crisis in 2008 was the next largest, financial correction we've ever seen since the Great Depression. And that was down, U.S. markets dropped 56% there, in a short period of time, and then took about 5 years to recover from a high water mark. And then this one here, we saw a drop down of about 34% with, very quick recovery in 5 months. But one thing that we often talk to clients about, and a huge part of our thinking on how we manage money, is that making money long-term isn't just about doing great when the markets are up. It's about protecting money when the markets are down. The less money you lose, the easier and the quicker it is to recover. And you can see that looking at those 3 different, downturns in history, the less money you lost, the quicker the rebound happened.
Yeah,
we want to go through
I think it's important.
Slide, or is this too? Yeah. Sure. So, one thing to note as well is that the recovery wasn't necessarily very uniform, and the performance of the S&P 500, was very disparate last year. Some sectors were up 50%, some sectors were down almost 40%. So a huge dispersion, in outcomes. So, we look at the S&P 500 as an aggregate of the 500 biggest stocks in the US and say, it was up 14% last year. But actually, if we carve out just the top 5 largest stocks there, the ones that most of us are familiar with at this point, the Facebook, Amazon, Apple, Microsoft, and Google side of things, those stocks were up 50% last year. And then the remaining 495 stocks averaged 6.3% on the year. So you could see, a huge amount of the performance was led by the bank stocks, these are tech stocks, and what really mattered was how you're invested last year. So one thing you'll note, for example, is that our growth portfolio did significantly better than our income model last year, and part of that was because it had more exposure to those high growth stocks that we saw on the tech side of things. Matt, you want to walk us through some of the trades we made last year?
So, sorry. As you can see here, it was quite an eventful year in both models. Below, we've listed 9 major changes we made throughout the year, and I'm just going to highlight a few of the more important ones. So in March, COVID news started to spread, and it really spooked the bond market. So with a lack of clarity and risk measures starting to increase, so that was credit spreads expanding, we decided to exit our credit position in PIMCO monthly income. Now, that was a long-standing holding for us, and we actually exited that trade in March the 12th. The following day, we started to use those proceeds to dip our toes back into the falling equity markets. So we were adding to equities as they continued to fall throughout March. The next month, we sold our low-cost ETF exposure to the international equity markets. And we elected to hire active management, which is a little more expensive, but we are hiring a manager to select the securities for us moving forward. And you often want to do that in a challenging market. Those trades actually ended up being quite accretive to performance, with the new actively managed positions outperforming the lower cost ETFs by about 15% on XML and about 10% on RIDH. Following that, in June, we sold off 5% of our TDUS blue chip equity position. Now, that is the position that held those stocks that Lorenzo just spoke about. So that's your Facebook, Amazon, Apple, Microsoft, and Google exposure. At that point, that position was up about 12% for our clients. We rolled those proceeds into our first structured note. So this was a structured note issued by CIBC, and the reference asset was Canadian banks. So at that time, Canadian banks had sold off at a multiple of the market. So they had sold off more than the market. And it created a unique opportunity to enter a trade where our clients would receive 10% interest every 6 months, as long as the banks traded within a certain range. Subsequently, towards the end of the year, banks traded up, and we are actually, that note was called, and the clients received back that 5% plus the 10% interest. So that kind of rounds out some of the larger trades we made throughout the year. Let's look a little closer at some specifics. So as you can see here, the top performing position in the model for us were those growth stocks. So that's that tech stock position held through TDUS blue chip equity, up 31 on the year. That's January through to December 31st. And then, interesting enough, our international actively managed equity position through Invesco. So the equity markets internationally were up marginally for the year, about 3%. This position significantly outperformed that due to its high exposure to the emerging markets, and particularly China. So China was the first one to grapple with COVID. So they're the first in, and they were actually the first out. So their economy actually rebounded quicker than the rest of the developed world. Next, as you know, part of the tenets of how we manage money is exposure to private investments. So we use private investments to smooth out and diversify our portfolio. So they continued to chug along, do what they're meant to do. Antrim up 7, Trez up just shy of 5, and Rise Properties, which is direct real estate exposure, just marginally up, just shy of 2. Now, not all trades that we make are going to go up. As you can see, our publicly traded real estate position through First Asset actually ended up down about -7% on the year. Not surprising, a lot of thoughts around real estate and how it will perform moving forward as we move away from retail malls and office space. So a little challenging for the REIT space, much like it was challenging for REIT investors back in 2008. We continue to like that position, though, as we do see some opportunity there. And then our 2 gold positions. So we have 2 gold positions, one in the growth model, one in the income model. As gold started to rally last year, we were a little late to the trade there. We entered the trade at the end of July, just as gold was hitting that $2,000 mark. Subsequently, it pulled back based on vaccine news and some other factors, but that created a little bit of a pullback and just poor timing on our part. We continue to want that exposure to gold to help provide that diversification that we need, as well as a nice hedge against the US dollar and inflation concerns moving forward. So Lorenzo, why don't you tell everyone what they're waiting to hear? How did we actually finish off the year?
So a little bit of suspense before that. So we wanted to kind of give a little bit of remind people essentially that, what we do for them is, we are top-down allocators. We take a look and we think about what are the main buckets we want to be exposed to. And those buckets could be real estate, they could be infrastructure, they could be equities, they could be fixed income. And then from there, we kind of, drill down further selections based on where we're at in the market cycle, and a variety of other factors. But important to remind you people that when we say we're discretionary money managers, being discretionary is not a carte blanche to do what we want. We have to stay within very strict allocations as per the investment policy statement that we have with you. And so we wanted to show people, what those ranges were and kind of where we were sitting in those ranges right now. So there's 4 different asset classes that our firm categorizes. They categorize cash, fixed income, equity, and alternative investments. And then for the income model, which is those green bars, we're allowed to be plus or minus, for example, cash 0 to 11%, fixed income, 20 to 40%, equity 50 to 70, and alternative 0 to 19. And that green bar you see, for example, for cash in the income model at 9% shows that we currently have a 9% weighting. Now, one thing I will note is that we have a very abnormal cash weight right now for two reasons. One, we had a little bit more cash near the end of last year as we were concerned about, a second dip with COVID. So we held kind of a 5 to 6% cash weight at various times after April of last year. However, there's about a 5.5% cash position in there from the structured note that we purchased for clients this past year. So CBL 11147, which was the structured note that we bought in June of last year on the banks, which was paying 10% every 6 months, got called in early December, paying a 10% coupon, so that 5% became 5.5%, and that was paid out. Now that will be reinvested in the coming 4 to 6 weeks. So that's that high cash position will be gone. But right now we're sitting on a little bit more cash. Matt will go over in a few slides why we're a little bit bearish, I would say, on not bearish, underweight on the fixed income things. We're also a little bit underweight right now, still relative to a neutral stance on equities, but we are overweight right now on the alternative side of things. So drum roll, please. This is what happened last year in the models. So TSX was up 2.2%. The S&P 500 was up 14.4. Again, if we take away just the big 5 tech names, overall the market was up about 6.3. International markets outside of North America in Canadian dollars were up 3.7, and emerging markets in Canadian dollars were up 14%. We're very pleased to be able to report that our income model was up 7.4% last year after fees, and the growth model up 12.6% after fees. And what makes that, I think, particularly a good number is that these returns were done with very low equity exposure. So our income model had about 50% equity on average throughout the year. The growth model probably had low 60% equity exposure on average throughout the year. So we achieved, in many cases, equity-like or better than equity-like returns with significantly less volatility. And let us visualize that for you here on this slide. So if you take a look at the green line up top, we just put the growth model on here since it had the most volatility of the two models, but the income model was even less volatile than the growth model. But that green line there is our growth model. The dark bluish line is the S&P 500, and that light blue line is the Toronto stock market. You can see that in the period of time where the S&P 500 was down 34, the Canadian markets were down 37%. Our peak to trough in the growth model is only down 16%. Consequently, by May, we were able to, I think that's May or maybe just beginning of June, we were back to being in the black on the year in our model, whereas the TSX, for example, wasn't back in the black until December of that year. Similarly, you can see that again in the two other red boxes that we've highlighted. They're in September and also in November, where look at the amount of volatility, the S&P 500 and the TSX, during that September period we've highlighted. The growth model just kind of steadily grew along. And again, making money long-term, it is our fundamental belief, as evidenced by a lot of research that we've done over the years, that making money is as much about doing well in the up markets as it is, not giving up those gains when things go bad. And so we feel that both models did a very good job at protecting wealth, accordingly last year. So on that note, Matt, do you want to give us the crystal ball forecast for 2021?
Thanks, Lorenzo. So we do quite a bit of research when we're positioning the models moving forward, and we've read a bunch of research, and we've kind of summarized it all here for our 2021 crystal ball. So big themes here: bonds. Interest rates are going to remain low, and they're going to remain low for quite some time. We've got more attractive international equity valuations relative to the domestic markets, and that's no surprise as the US has kind of just rebounded quite quickly. We've got an interesting thing happening in the emerging markets, and then One of the common themes that we've always been part of, and we see moving forward and a lot of growth in that space, is the use of private investments or alternative investments in a portfolio to help smooth out that return pattern. So first, we're going to start off with the bonds. So you can see here we've got a 150-year chart of interest rates on a treasury or bond. And you can see we're at the very low end of that range. So rates can't go much lower than they currently are, and it's going to be challenging for governments or policymakers around the world to increase rates when we're still grappling with the effects of COVID. So from what we're reading, it looks like rates will remain low or in this low range for the next couple of years. That's going to make it particularly challenging for your term deposit or GIC investor, where a 1-year GIC right now is paying somewhere around 0.5%. What's even more challenging is eventually once rates start to rise, it will have downward effect on bond prices. So that's what we're showing here. Typically, you add bonds into a portfolio to offset your equity losses. So when equities fall, bond prices typically go up. And you can see that here with this little bar graph on the right. When the equity markets fall, traditionally from 1950 to 2020, if equity markets are off 7.5%, bonds are rallying about 1.8. However, in the last 5 years, when equity markets are off that same amount, bonds have rallied half of that. So you're getting half of the diversification that you used to by adding bonds to the portfolio. So as interest rates start to normalize and they start to go up, bonds will be a little more challenging. And that's why we have been a little underweight bonds, and we've replaced that exposure with the alternative or private space. Next are equities. So what we've got here is the S&P 500, and we're showing here from 1996 to about 2008, the US equity markets traded sideways. After the great financial crisis, however, we've had this expansionary period in the United States where equity markets have pretty much gone up uninterrupted except for COVID happening. So really what we're showing in the next box is where are they going to trade? Are they going to continue this run, or could they trade into a sideways pattern? If you look at that relative to international equities with the purple line, international equities have, for the most part, traded sideways for the last 20 plus years. So from a valuation standpoint, international markets look a little more attractive to enter than the more expensive domestic market. In this case, we're talking about US equities. More interesting is when we look at international equities, looking specifically at the emerging markets. So you can see not only are they cheaper, they are expected to grow or expand at a faster rate than domestic markets. And that's, as I mentioned before, part of the reason is they were first into COVID and they were the first out. And you can see that with the caseload on the left-hand side there. Finally, alternative or private investments. So for those of you who are new to our style of management, we use alternative or private investments to help further diversify a portfolio, provide stability, and smooth out return patterns. We see this theme continuing as we move forward, particularly in this low interest rate environment. So alternative investments are very highly utilized in pensions and endowments. And what we've shown here is we're showing the Canadian pension plans allocation, and they're about 60% into alternative or private investments. Now, we don't have the ability to go to a weight that high for our clients, but we do utilize the same exposure of real estate, infrastructure, and some private equity in certain cases.
All right, so let's take a look at the instruction notes. So those of you who are clients will probably be familiar that last year, the financial crisis provided an incredible opportunity to build some structured notes. We did 3 structured notes. One of them was inside the models that we did for clients, and that was that bank note. We also did a very similar note for clients outside of the models, and we did a third one, which was an income note. So today, we are launching 3 notes. So we have spent, Matt and I have spent the better part of the last 2-3 weeks discussing various options with the 5 Canadian banks and their trading desks and trying to understand what attractive structures might be in place and what ratio of features, that we would want to kind of come out with the best option. There are 3 sectors that we thought might be interesting to look at. 1, banks; 2, airlines; 3, energy. So when you take a look at the chart in front of you, what you can see is all of the various sectors on, I think that's probably the S&P 500. Yeah. And how well or how poorly they did last year. Obviously, e-commerce, the Amazons, the Netflix of the world, those were the big winners. And no surprise that the airlines and energy, hospitality, were the big losers. So why do we take a look at the right-hand side of this graph? 2 reasons. 1, volatility. So the more volatile the price of the asset, the more valuable those options are going to be, and the more attractive the coupons that we can build into those notes. Secondly, we're hoping for a recovery so that note gets called in a reasonable period of time. Even though all 3 of these notes that we're launching are technically 7-year notes on paper, most trading desks will price notes so that they're called on average within 2, maybe 3 years. That's how they're pricing, these structures. It's very unusual that notes go, much longer than that, even though potentially that they could. Ultimately, why we have built these notes, we're offering these notes to clients, is that, most analysts seem to be quite optimistic about the markets for this year. We certainly hope that to be the case. But should that not pan out, we always want to have a few irons in the fire where we're still making money, even if things trade sideways or go down. So we've kind of structured, our notes with that in mind right now. So the first structure is one that you guys will be very familiar with because it's the same thing that we did last year. Now, volatility is not what it was in summer of this year. So the rates are going to be a little bit less. Instead of 8% every 6 months, it's 6.05% every 6 months. But, I look at it this way. Right now, we're sitting at all-time low interest rates. We had a client call us earlier this week asking for a GIC, and the best GIC rate that was available to us on our rate sheet that we could broker was, I think it was 86 basis points. It was 0.86%, not even 1% for a 1-year GIC. GIC rates are abysmal. So in that kind of very low interest rate environment, if you're telling me that if I'm owning an underlying basket of bank stocks, that at any point on an observation at 6 months down the road, when it gets called, for every 6 months that it lasts, I'm getting paid 1% a month, essentially, or 12% a year. To me, that's a very attractive risk to return payoff. So this is a semi-annual observation on it, a 6% coupon on it. So any period of time at a 6 months observation where the note is trading at less than the value of those bank stocks were when you purchased them for, the note will accrue that 6% coupon and then move on to the next observation. And at the first observation, within that 7-year period of time, where the value of the underlying assets is worth more than what you purchased them for, the note expires, you get your principal back, and you get all of the accrued payments. So to be clear, an auto-callable structure like this pays out all of those coupons at the end, not during the life, as opposed to the notes that Matt is going to discuss here in a second, which are the contingent coupon notes. I'll also just mention briefly, for the sake of this presentation, I'm not going to go through every single scenario, but we've listed out essentially at the bottom half of this slide in more detail how these notes work, what happens on each of the observation dates, and what happens in the unlikely event that a note like this goes to maturity. I'll also show you at the end of this, we've built a custom structured notes page just for our clients so that we can better explain exactly, in more detail how structured notes work. So Matt, you want to take us through?
So this note is a little more confusing, if it could get more confusing. This note is structured on the Canadian Pipeline Index, and it will pay a monthly interest payment into cash, so into your account, at a rate of 1.36. That works out to about 16.3% annually, and the note becomes callable on the 6th month. So after 5 observations, the note could be called if the Canadian pipelines are trading at the same price or better when we entered the contract. So it's a very similar structure in we're asking the investment just to be flat or better and you're back into cash, but to be compensated along the way instead of getting paid the interest upon the call like we were in the bank note. So this one will pay a monthly yield of 1.36 as long as the pipelines trade in a range anywhere between where we entered them and -30. So you're going to be clipping this interest along the way. So you're compensated to wait out this trade. So as long as pipelines are trading sideways, you're going to be receiving this 1.36 after the 6th month. If they do trade marginally up, you're going to be back in cash and the note is done. So there are various, like Lorenzo said, scenarios that we've laid out below that'll explain if this were to go full term, which is 7 years. So by increasing the frequency of the observations, so in the note that Lorenzo explained, you get to look at the note twice a year, every 6 months. So you have 2 times to be called. When you increase the frequency of call, in this case, 12 times a year or every month, you have a higher likelihood of being called. And that's why we've done that. We've selected a more volatile reference asset, but we've put a more conservative structure around it.
We've also purchased more protection on this. It was a 30% downside protection instead of 20% on the other note.
So the last note is exactly the same structure, but it's an equal weight basket on a recovery trade in the airlines. So we all probably saw the news yesterday about Air Canada cutting jobs and cutting some of their routes. So right now Air Canada is flying at about 19% of the routes that it was flying back in January of 2019. And the share price has reflected that. Pre-pandemic, AC shares were around $48 and now they're trading around 22, 23. Today they traded up based on some further vaccine news, but they're nowhere near anywhere where they used to be. And that's because airlines aren't earning anywhere close to what they used to. So instead of entering a trade that is quite risky, and a lot of clients have been asking about this recovery trade because myself, I can't wait to travel once we're all vaccinated and it is safe to do so. So there is a lot of pent-up demand for travel, but it's a risky trade to buy airline stocks because you could be waiting out a recovery for years. Instead, what we've done here is we've given our clients exposure to the airlines and they're going to get compensated at a rate of 1.09% every month as long as the airlines trade in a range between where we entered the contract and -30. Same thing with this note, it's callable after the 6-month mark. So again, in July, if the basket of airline stocks trades marginally up, you will be back in cash and then no longer exists.